One of the largest bottlenecks to adoption of stablecoins and platforms is also simultaneously derived from things that enterprises maybe kind of get the wrong impression of.
That is Chunda McCain, co-founder of Paxos Labs. After years of helping enterprises enter crypto, he believes many companies are still approaching stablecoins with the wrong assumptions, and that mistake is slowing real adoption.
My whole philosophy is if you're in the game as an issuer to monetize your stablecoin, and that's the end of the sentence, you're not thinking the right way. Stablecoins are a wedge to build better business around digital assets.
He explains what enterprises keep getting wrong about stablecoins, what separates distribution from real utility, and what comes next as digital asset infrastructure matures. By the end of this conversation, you will learn why stablecoin adoption is harder than it looks, where enterprises misjudge the opportunity, and how the smartest players are thinking beyond issuance towards stronger products and better financial rails. I'm Alex Nwaka, and this is High Stakes. Welcome back to another episode of High Stakes. I'm your host, Alex Nwaka, and today I am joined by Chunda McCain, who's one of the co-founders of Paxos Labs. Welcome, Chunda.
Great seeing you again, Alex. Always a fun time getting the chance to chat.
So Chunda, maybe, let's start just a little bit with your background. You've been in crypto for about a decade now. Maybe talk a little bit about your journey into the space. What drove your conviction to get into it in the first place? What keeps you in it?
I think a lot of it resonates to the reason why I'm still here today, and specifically why we're working on at Paxos Labs. So the origin story, there's an origin story when I first touched crypto and got my first experience crypto. And that was seeing my father actually build a Bitcoin mining rig back in 2015, working with hardware. And at that point I was like, oh, this interesting project. What are you doing? Ever since I was young and growing up, my first computer was built by him. We've been in a tech-centric family, specifically on the hardware side. He hands me this paper. He's like, hey, read this. I'll give you the context. It was the Bitcoin white paper. And so that was my first introduction to learning about crypto. But honestly, it didn't grab me. I thought it was an interesting technical concept and computer science kind of initiative and philosophy, especially around the self-sovereign nature of Bitcoin back in the day. But the immediate thing I was thinking was okay, what am I going to do with this? And there really wasn't an answer. This was 1 year post ETH ICO. And so the days of building things on smart contracts and that was very early. And so the aha moment for me was the moment where I really saw that you could do things with blockchains and on blockchain tech, which was in 2017, 2018 era, specifically with the birth of DeFi, specifically with ETHLend, also now known as Aave, understanding peer-to-peer lending markets, and specifically within the context of, at the time, I was thinking about my grandfather who ran a mom and pop restaurant, who's an immigrant from Taiwan. We were okay, how could someone like him, who may not have extensive credit history, just came to the country, but operates this business, how could he have the capability to access financial rails in a way that's intuitive to him and also addressable to his constraints? And when I looked around, I felt there wasn't really a satisfying answer, and I realized, wait, there's an alternative where you could just build that answer. And so fast forward 10 years later, I joke that the protocol I wanted to have built back then is now something that I get to spend every day of my waking life being able to go and build and bring to people today. And so I definitely feel that full circle moment of it's about getting people where they're at and helping them actually move the needle forward on the things that matter to them, and then to being able to have the freedom to provide that access to as many people as possible. And that is the reason that I'm in crypto today.
So Chunda, some of our audience will be familiar with Paxos, but some may not. So maybe just a quick primer on Paxos, what it does, and then frankly also what the relationship is between Paxos and Paxos Labs. And how that all ended up coming together, and you being one of the co-founders of Paxos Labs.
Yeah, I'll tell the full story. So Paxos is a regulated enterprise crypto infrastructure provider. It's been so and has done so for 13 going on 14 years now. A fun fact that our CEO Chad likes to say is Paxos predates Ethereum. And it's something that not a lot of companies in this industry can say. So back then, the philosophy of Paxos was always about a similar problem to the philosophy that I have personally around crypto, which is what is the best way to provide access to digital financial rails to the largest amount of people possible. And the philosophy that they landed on was, all right, we need to, one, meet people where they're at, whether that's from a regulatory perspective, but as well as from a enterprise perspective, like go meet people with the enterprises they use today, with the applications that they use today. And second, let's get their foot in the door on the highest value use cases that act as this first step activation for enterprises, right? And so Paxos focuses on the set of what we call first step capabilities that include asset issuance, specifically stablecoin issuance, as well as like some commodities issuance, orchestration, which is fiat to stablecoin on and off ramp, primarily for enterprises. So for context, Stripe is a client. If you send a stablecoin on Stripe and it settles out into fiat as a merchant, it's actually powered underlying by Paxos Rails. And then finally, crypto brokerage. So that's buy, hold, sell digital assets. So if you pull out your phone today, go on Venmo, buy Bitcoin, or you open up your interactive brokerage account, buy ETH, that's Paxos infrastructure in the back end. So it's very much about, all right, how do we go take that first step to bring these massive enterprises to crypto, but also how do we take the first step to enable everyone to get a little bit closer to the benefits that crypto can provide. So that's been the story for the past over a decade now. But a realization that was had almost 2 years ago now was this question, this looming question, which was, all right, it's fantastic everyone's taking this first step. I think we realized at the end of 24 that it's inevitable. A lot of the enterprises that we had already worked with, a lot of the enterprises that we were talking to, it wasn't a question of if, it was a question of when for them when it came to integrating crypto capabilities. And the one thing we realized was the biggest hurdle after you bring these people onto that first step is, how do you make sure that everyone's successful? How do you make sure that people can actually go and actively use these assets? Something my co-founder Bo says that I really like is, if we look 5-10 years down the line and we see that, after all that, everyone can now just buy Bitcoin on JP Morgan, we would probably look back and say we failed, right? There's more to what was expected from DeFi, from crypto, from the self-sovereign philosophy than buying spot crypto assets on a brokerage, right? And so the philosophy of Labs is, how do we actually go and build that connective tissue between the bare metal off-chain infrastructure that exists and the bare metal blockchain-based infrastructure that exists, right? And so the philosophy of Paxos Labs is to take a very kind of on-chain, blockchain-based centric approach of building out what we call these next step capabilities, asking and answering the question, what do you do after you get that first touch point with digital assets? And that usually looks like moving digital assets around on chains, like cross-chain movement, stablecoin to stablecoin orchestration on different blockchain networks. It looks like generating yield on different assets, gold, stablecoins, et cetera. And then also accessing credit against digital assets, whether they be endogenous digital assets that exist only in the crypto landscape like Bitcoin, or tokenized digital assets that we're bringing onto the blockchain, such as like tokenized securities, commodities, et cetera.
You've talked to me about, sort of the product, sort of viewpoint of Paxos Labs in terms of what sort of the mandate means from a products and a capabilities perspective. Can you maybe talk a bit more about that sort of product and capabilities framing, where you guys are focused today and how that may evolve in the future?
There's something that I like to say, which is, I think, well, the saying I like to say to folks is, I don't sell capabilities, I sell solutions, right? And what that means is, I think historically, for better or for worse, and also due to the limitations of technology and the regulatory landscape in crypto, we've been in a position where, a lot of times getting someone's foot in the door and getting that first step is selling them a very tightly knit and buttoned up capability. Buy crypto, hold it on your exchange. Get a stable coin. Get from your dollars or your pounds to a stable coin, right? But what we're realizing now, especially over the past year, is a lot more enterprises are coming to us with problems and not necessarily coming to us with capabilities they need. They say, hey, I have all these dollars on my platform. Let's say I'm a payment provider. I have all these dollars on my platform. They're constantly leaving. Is there a way that I could retain them and monetize that volume, right? Or it could be a bank saying hey, I have this ability, but to lend out assets, but the borrowing side of that capacity is constrained. What else could I do to generate more active demand for that capital? And the list goes on, right? But the mental shift here is people are now looking at crypto as a solution to the modern financial system and saying oh wait, this system and these capabilities have existed, and are being actively built out, not only address what we think of as, these crypto native use cases, but actually can just I think we all envision, for those of us that have been in the industry longer, just build a better version of finance. And so that is kind of how we internalize this idea of selling solutions, really going in enterprises, understanding the problems that they face, and then offering crypto as a better version of finance to solve those problems.
And I'm curious, Chunda, when you look at the customer base today, or just sort of how you would segment the customers today on sort of the Paxos platform and what Paxos Labs is servicing today, one, how would you describe that segmentation? And then how do you see those segments evolving maybe over the next 12 to 18 months? Are they going to stay the same? Are they going to evolve into folks that are new that are coming into the space? I'm just curious, where do you see sort of the customer base in the different segments, and how do those evolve over the next 12 to 18 months?
It's a great question. I actually just did an exercise with my sales team yesterday on working through, okay, what does customer segmentation actually look like, and where are the similarities between different customer types? Because the honest answer to who have we had conversations with, who has come to us, who do we talk to? It's pretty much everyone, from top 50 banks to large brokerages and FIs to really esoteric entities like payroll companies specifically focused on a niche set of laborers, or we've also spoken with religions, nation states we've had conversations with before. And so that's a really broad spectrum of clients. And we honestly internally always struggle with okay, how exactly do I fit these folks in with with the rest of the standard, more traditional finance clients that we're targeting. And the way that I think about it, though, from a heuristic standpoint, is there's kind of two buckets of clients. There are clients that move money, and there are clients that custody money, right? And then you'll have various different activities people will do within those two buckets. But realistically, those are kind of the two actions that anyone is doing. And so when you look at clients that are moving money around, payroll providers, payment service providers, orchestration platforms, et cetera, credit card issuers are another good example. Their set of problems are usually around how do I create this new type of user behavior on my platform where I'm trying to create an incentive for my users to retain on the platform. Because traditionally that's not what their clients are used to. And so the muscle that we're flexing and building around is all right, how do we help get you to train your users to look at the benefits of keeping money on your platform, and then enabling to move them into this kind of money custody pile. On the money custody side, a lot of them are basically asking the question, all right, my users are usually doing one of two things. They're trading or they're saving money on my platform. How do I enable a lower cost of capital on trading, or how do I enable people to generate additional income on my platform? And so that on that side, we're looking a lot more on things like, all right, how do we access new sources of yield through on-chain finance, DeFi, and crypto native solutions? We also look at things like how can we combine traditional finance markets with things like the liquidity of on-chain rails and combining those things together. So folks who are, let's say, maybe using a yield-bearing instrument to trade or as collateral for trading to decrease their cost of capital have the ability to get in and out of those assets. So that's kind of the high-level breakdown of the market. And then when you get down in the weeds, like, yes, a payroll company is going to look different than a payment service provider on like how you incentivize that user behavior and like what the call to action looks like for the user, et cetera, et cetera. But that's an implementation and execution exercise, less so than a segmentation exercise.
Probably the first time that I've heard somebody include in their like customer segmentation religions and nation states, and so definitely a wide swath there. Chunda, if you look out, let's call it 3 to 5 years, and Paxos and Paxos Labs by extension are extremely successful, like in like the most extreme upside scenario. What does that world look like for Paxos? Like, where are you all in the stack in terms of what you own, and what types of maybe solutions are you providing out into the market that you think just like don't exist today and change the world in some way, shape, or form?
The way that I look at it is it's a phased rollout. The first step is getting everyone to embed digital asset native rails into their pre-existing financial workflows and pipelines. The next step is to, after they've taken that first step, which can take a long time if you're really embedding like digital asset native rails at the bare metal. But once you've taken that first step, which could take up to 12 to 24 months even for some clients, the next step is completely replacing those underlying rails with purely a fully digital asset native, crypto native, however you want to frame it, infrastructure and plumbing to support their use cases. So for example, a fantastic example that I've been kind of like workshopping with a few clients that are really forward looking here is a lot of PSPs come to us and say, hey, something that we have seen like done once, like on the Square block side of the world, is the idea of like being able to help our merchants who are using our infrastructure with financing and credit. The plumbing that you have to stand up to enable that in a traditional finance context is enormous, right? The credit underwriting, managing flow of funds in a whole bunch of different jurisdictions, the currency settlement, and then you're also doing this with merchants that exist all across different segments, right? The core complexity of that is underwriting, right? And kind of fitting your underwriting model to match the different segments of merchants that you have. But the hard part, where most of the work comes from, is the payment ops and the cross-border remittance. And you end up staffing like this gigantic team to just handle that when you should be focusing on the thing that's your core competency, right? That where you have all the data. And so many PSPs have come to me and said, hey, like, we would love to do this. What would this look like if we actually could do it with you, if we do it with on-chain rails? And what I like to say is the future is where the companies that focus on distribution or their core competency get to do that. And financial rails are just an automatic backend that they don't have to think about. You don't have to staff a 50-person payment ops and compliance team in multiple jurisdictions to coordinate your credit settlement. No, you use a fully out-of-the-box global on-chain settlement engine that can enable you to finance credit from institutions that are offer these opportunities because they're part of this decentralized and open and permissionless network. And to be able to offer solutions like that to enterprises not only helps enterprises, improve their bottom line, but allows them to offer better products to their clients that traditionally they would just look at it and be like, oh, we just can't support the investment here.
Got it. And you get to speak to a ton of institutions, and I ask a lot of the folks that come on to the podcast to describe how they would articulate where we are in sort of the arc of institutional adoption and why they feel that. Can you maybe give your sort of editorialized version of where are we in the institutional adoption curve or arc, and what things, whether that's problems or solutions that institutions are pining for that you just think again are part and parcel like with where the market is right now?
I think, and this is where segmentation matters a lot, because I think the answer there varies wildly depending on who you're speaking with. I think if you look up market in the FI sector, we're still getting people across the line on access, like accessing digital assets, that first step. I would say the job is done from a demand perspective. The job's not done from an execution perspective. As you've seen from recent news on our side, the demand is there. However, it takes time for these things to scale and get to market at scale, right? So I think when you look up market, that's kind of where I would still put us at executing on the demand on those first step capabilities. Where I get really excited though is when we speak with platforms that have already, I won't say like maximized, but have really found their niche in the market and captured a customer or an audience. And they're now thinking, all right, how can I expand my offerings, or how can I make my offerings better, cheaper, faster, more efficient, et cetera? And you're going to look a little bit down market from the FIs, this quote unquote institutional, into what I call like enterprise, right? Payment service providers, neobanks, et cetera, which have captured their market, but still have a lot more to offer from a product perspective. That is where we're seeing the rubber hit the road when it comes to people taking full advantage of the full suite of capabilities that crypto has to offer. And that's where I think the most exciting part of the market from a product innovation and kind of pushing the boundaries perspective really sits today.
So I want to move into talking a bit more about stablecoins and how you see sort of generally like market structure. Again, Paxos has a very like sort of deep history with stablecoin issuance. Obviously, we're living in a post-Genius Act world, and I think you can't really have a conversation in digital assets without talking about stablecoins, especially with institutional folks. When you think about like how the stablecoin market is going to evolve, and whether you want to define that as what is the like long-term set of differentiating factors, what's the long-term moat for a stablecoin issuer, how do you think about sort of that, the market developing and like where we are today?
Yeah, so I think there's two different layers of stablecoin issuance, and I don't know if the majority of the market has internalized this structure, but I think the longer, and from a lot of the learnings of being some of the first movers in this market, and also understanding a lot of how enterprises are thinking about stablecoins today, is what kind of inspires this perspective. But there are two, I think, different structures of stablecoins. There are settlement stablecoins, and then there are economic stablecoins, right? Now, settlement stablecoins are the stablecoins that we're all familiar with, who have the most market share. The ones issued by Paxos, the Circles, the Tethers of the world. There may be like call it 2 to 5 others that could get a position or a place in that race, where they act as the bedrock for dollar-based collateral in global finance, right? And the focus of those stable coins isn't necessarily anchored on, all right, it's specific to this platform, or like even that, we're monetizing on every dollar. It's more on, okay, like how can we distribute this stable coin as a representation, tokenized representation of the US dollar, and as broad spectrum use cases, applications, markets as possible, right? And then you're seeing this emergence recently of what I like to call like these economic stable coins, right? Now, why economic? Aren't settlement stable coins also economic? Well, I think there are a lot of platforms that have looked at the emergence of stable coins. They've looked at the revenue that Circle generates, or Tether, right? And they'll think, okay, this is really interesting. I have a lot of dollars on my platform that are active, being utilized. I want to tap into that revenue as well, right? And so for them, they're thinking of stablecoins as an economic vehicle for their platform. But if you talk to neobank number 6 or whatever, right, and you're asking them the question, oh yeah, do you expect, people in the Philippines to be holding your stablecoin? Let's say they're domiciled in Europe, holding your stablecoin as like a settlement asset for like Forex transactions against the peso there. The answer is no. Like no one from the product or corporate strategy side on that company's like, yeah, we're going to be the global settlement asset for everyone. Like that role and that responsibility is different. But they look at stablecoins from an economic perspective and say, those economics make a lot of sense to us, right? We want to capture those economics. And so we're seeing this explosion today of a lot of platforms coming to that realization saying, I want to monetize the dollars on my platform and looking at stablecoins as a solution for that. And so a lot of where I think the market goes is that the margins on settlement stablecoins, when it comes to NIM, compresses to zero in the long run because the value in stablecoins is distribution. And every platform is going to want to capture the value generated from the fact that they've done the hard work, which is distribution. The value from stablecoins for the settlement layer is, okay, well, now I have this, basically fungible version of a digital dollar that exists in all these platforms and all these ecosystems and all these jurisdictions. I can now build novel products on top of that. I can build novel products around it. Either they be, fully regulated within the context of like traditional financial systems or on DeFi, and I can then monetize that. My whole philosophy is if you're in the game as an issuer to monetize your stablecoin, and that's the end of the sentence, you're not thinking the right way. Stablecoins are a wedge to build better business around digital assets. Because at the end of the day, the people who should generate the economics from stablecoins are the people who do the hard work of bringing people in to hold those stablecoins, which are the end user and those platforms that are doing the hard work of distribution.
I'm curious, Chunda, when you think about what the gating item is for broader adoption of stablecoins, what you think that is, whether that's liquidity. I know you spent some time just talking about the importance of distribution. And then maybe as a follow-on question, you deal with a lot of institutions that are coming to you to get a sense of enabling stablecoins for their business. And I'm curious what you think they get wrong coming to you and in terms of like what their assumptions are, both in terms of how they're going to utilize stablecoins or like what the product market opportunity is for them.
So I'll start with the former. On the gating side, I think primarily where you see systemic limitations on growth, which, if I'm being frank, I think growth is ramping at a good pace. Honestly, from the largest enterprises, it's primarily regulatory. I think even though the Genius Act is passed, there's still contention on certain pieces of stablecoin legislation that are being debated into clarity now with the yield piece. And not only that, there's still ambiguity around how exactly the OCC or like many of these oversight agencies are actually going to regulate within the bounds of how they manage oversight on the entities that exist as the issuers. And so I think if you're looking at this from the perspective of a large FI, or even some of the larger like fintechs and exchange type platforms in the market, let's say you have the assumption that, hey, I'm going to pass through yield to all the users that trade on my exchange. That assumption of what you might want to use that stablecoin for could in a quarter or two completely change. The progress we're making is fantastic, right? But it's still at a pace where, a lot of enterprises are constantly, shifting their focus and their concerns and trying to hedge out the risks that, the assumptions of why they wanted to use a stablecoin and leverage it will actually still be compliant in the future. So I think that's a large barrier that we run into a lot. The other things are just, education, activation, and like what the process looks like to embed a stablecoin. To go, and this is actually a great transition to the second piece, because I think one of the largest bottlenecks to adoption of stablecoins and platforms is also simultaneously derived from things that enterprises maybe, kind of get get the wrong impression of, which starts with, I think, one of two things. I think one thing is wanting to build out a stablecoin completely from scratch, bare metal, bottom up, when the thing that they really care about is the economics. One of the biggest learnings of the time that Paxos has spent building PayPal's stablecoin and helping them scale it is the realization that it takes a lot of money, effort, and time to scale a stablecoin. Money, effort, and time that most enterprises are not willing to invest. And also, most enterprises still need to embed it into the core business, even after spending all that money and time, for it to be successful. It's a massive strategic focus, it's a massive monetary drain, and it's a massive kind of human resource sink. The way that I kind of frame doing bare metal issuance is that most enterprises think of stablecoins, like bare metal issued stablecoins, as revenue centers. I'm like, no, they drive costs first. And then 2 to 3 years down the line, you'll make something on the back end and that revenue will scale and it'll be worth it. But you have to be willing to spend that time, money, and energy to get it off the ground. And so I think a lot of, especially like I'd say like mid down market enterprises come into the market saying like, oh, okay, we're going to go do this and we're going to bring it to market. But the time it takes to really do that is much larger than expected. It's really easy to get discouraged and say, okay, this isn't even worth our investment. If you spend 2-3 years trying to scale stablecoin, it fails and you have nothing to show for it. So to be honest, that's something that concerns me a lot when I look at enterprises taking these steps to integrate stablecoins or embed stablecoins or issue their own, where I'm like, we need to make sure the track from taking that first step to driving revenue, to creating user engagement, to driving retention, that has to be seamless and it has to move quickly. Otherwise, we're going to see a lot of attrition. And this is attrition that has already happened. People forget that in 2018 and 2019, enterprise blockchains were a thing, and there was a lot of investment into it. And it didn't work because that investment didn't pay out dividends, results-wise. And so we need to make sure that the investments that are being made today actually pay out.
Maybe transitioning to your thoughts and how to frame on-chain asset management. I view a lot of what Paxos Labs is doing, and especially as you describe, there are folks that kind of move money, and then there are folks that provide custody. I think in that there's sort of an element that is like, what are the financial asset management products that you're able to offer folks that have value stored with you, right, or custodied with you? When you think about what on-chain asset management effectively means in practice, like how would you describe it, and what do you think are the core components of it today, and where it could go?
I want to clarify that to say that we don't look at ourselves as a asset management firm. In fact, we have had many a conversation internally on how can we ensure that we aren't centering the business around asset management, because that is, I think there's a whole sector of really talented, both incumbents as well as new entrants in the asset management ecosystem, whether crypto native or not, that have a lot of evergreen space to really expand their business when it comes to on-chain asset management. But from our perspective, where we're focused is more answering this question: what does enabling on-chain asset management look like? What does enabling users to actually actively access credit or actively manage their own assets look like? It's a little bit of a lower level where we're trying to look at, all right, what is the missing infrastructure that can help enable this explosion of traditional asset managers to come into the ecosystem? Because I think something that, to the chagrin and I think rightfully, for a lot of people who have been looking at DeFi the past 2 quarters, honestly, the past 4, we've seen a lot of explosions of capital implosions of capital because of the issues around not having competent asset managers in the ecosystem. And to me, it's a scale and it's a tooling problem, right? And so we're thinking ourselves of how do we make sure that we can offer the correct amount of scale to bring asset managers that deserve to manage these assets at the scale they exist on chain. And then two, how can we make sure we can provide them the tooling so that way they can do this with confidence that, one, they can do it compliantly, which is a big, I think, missing gap today. And then two, that they can do so without, having to build out tooling that they're not familiar with in a market with a technology they're not familiar with.
Can I also tie this to, sort of our world of Validation Cloud on infrastructure? I mean, I think there's an element here of as institutions continue to move into digital assets, there's, sort of core infrastructure components here that are, whether it's validators or it's node infrastructure. I'm sure you just saw the news yesterday or announcement by Visa and Zodia that they're going to be running validators on Tempo. And so I just think that there's more of this starting to happen and it's showing up in the news. Could you just sort of steelman like why institutions would ultimately want to own those portions of the stack, specifically like validator infrastructure, node infrastructure? We're starting to see it make its way into the news with certain institutions, but I'd be curious, since you've spent a lot of time thinking about the infrastructure component of the space, how you would articulate that.
Yeah, the way I look at it is this, right? There are two things when you're a large enterprise and you're thinking about making an investment in new technology, right, or an expansion of the business. There are two things that matter to you the most. One is like where's value sit, and then two is like where can I mitigate risk. That's pretty much you go propose anything to anyone, they're going to ask you those two questions, like what are we risking and how much money is it going to generate, right? Or how much money is it going to make us, right? And so when you're taking things from that perspective, it makes a lot of sense for these enterprises to go and take that step to own the underlying infrastructure attempt and start to make those infrastructure investments, is because it answers those two questions, right? It enables them to have ownership of where value is captured at the network level, at the infrastructure level, right? Which is why, we've spent that decade plus investing in infrastructure and building out infrastructures, because that's where value sits, right? But secondly, it's also about a risk management piece, right? Like, you will only be able to have comfort of deploying onto a network, of deploying into a given protocol, of being able to expand your product suite to encompass some on-chain capability if you have familiarity and some form of ownership under that underlying infrastructure as well. And so I think it's those two things, honestly, right? It's the common matrix of decision making when it comes to where you want to allocate resources, and it's just a common sense investment, I think, for anyone who sits in that seat.
And do you think that there's certain elements or attributes that become more and more relevant to that infrastructure layer? So the thing that we've seen is that performance, scalability, and compliance, like, I've never met an enterprise that wants less of those things. When you think about what becomes important in terms of attributes, in terms of the infrastructure component, what do you think becomes really, really durable or is a major differentiator in terms of how those things are run and what capabilities or what results they generate for those folks?
If there's one thing that I know enterprises like, it's, and we constantly have internal conversations about writing, I think there's a fine line here from a product perspective, is configurability. Every enterprise's user base is different, right? Every enterprise's needs are different. Every enterprise's scale is different. Every enterprise internal operations are different, right? And so when you're doing the decision analysis on whether it's the service provider or investing in infrastructure, one of the biggest things you're going to ask yourself is, how can I make sure that this can be the right fit for my platform, right? And specifically my platform. And there's a bunch of dimensions of which that checklist gets checked off. But for anyone who I think is taking that step to build infrastructure or is focused on building out infrastructure, that level of configurability, whether it's on the data side, which I know you guys are making a lot of investments on, validator infrastructure, on-chain settlement or orchestration infrastructure, that's something that I'm facing every day when it comes to how can I make sure that whatever expressivity our counterparties want to include and how their products look, feel, smell, taste, etc., to their end user, they're able to implement that and express that in the product.
Yeah, and to take your sort of dovetail there, we have spent quite a bit of time investing in sort of data and AI as sort of a capability, and I think our insight there is that ultimately data intelligence, market intelligence allows you to do really interesting things around investment for growing wallet, share of wallet. If you are a company in this space or orthogonally like in this space. When you think about the utility of data in sort of the context of Paxos, right? I would assume that some of it would be, hey, great, it's great to understand issuance, but it's like really much more interesting to understand activity, sort of like how stablecoins are being utilized. But when you think more broadly than that, in terms of what you see as sort of the data utility as it relates to the broader scope of what Paxos is doing today and what's going to do in the future, how important do you think data becomes in that?
I mean, data is absolutely crucial, right? It's something that I think we're spending more time investing in recently, especially because I think there's a bit of a unique positioning on our end where it's, on the labs and on the core side, we sell B2B, and there is a sense of disintermediation between us and the end consumer, right? Because although there's usually an end consumer on the other side of the enterprise we're selling to, we don't get to directly interface with them. A lot of times when we're trying to guide clients into making the decisions that'll be most successful for their implementations, if I'm being frank, it's a little bit heuristics driven, right? Right. We could say, hey, this has worked for so-and-so clients before. We've seen this activate well, but there's a lower level of information there where if you were to ask me, like, do you have 100% confidence, you know exactly what their user base is doing? Obviously, the answer there is no, right? And I think the answer there is no as well, because we haven't really expanded to the realm of building on-chain products at scale, but the beauty of where you get data, AI, and blockchain capabilities is when you actually have people settle on-chain rails, and then you can leverage all the advancements we're building on data and AI. Well, now we can go and take on the responsibility of generating those insights for our clients and say, hey, we have this data, not only from a heuristics point of view and pointing and saying, what each client did and what was successful and why you should do so and so, but we can say, hey, like, here are the numbers. Here's what their users did. Here's how they activated. Here's what drew them to the platform. Here's when there was attrition, right? And so data is extremely powerful, and being able to empower, not only enterprises like us who build infrastructure for consumer-facing platforms, but also directly for those consumer-facing platforms when they're building out crypto infrastructure to go and say, oh, wait, I actually know exactly what is driving impact, and I know exactly what isn't, and I know where to invest and where not to.
Totally. I think if you looked at any, what I would call like Web 2 business, the concept of not having good attribution of like where their users come from or what their users do on the platform seems crazy. And again, we're approaching an inflection point, I believe, in the digital asset realm where that becomes increasingly more important. And frankly, something that we're making available to folks that not only are what we view as distribution channels, but also we view as like directly interfacing with, sort of institutional capital, which becomes really important. Chunda, maybe in terms of, sort of the last couple questions, when you look out and you say, what things need to be true over the next 24 months for, maybe Paxos in an idiosyncratic way, but then also as you look out and say what the, broader market potential is for digital assets, like what things do you think need to be true for the next 24 months to look like the best, like happy path you can possibly imagine for the industry?
Yeah. So I'll start this first within the context of what I think we would like. I think that a few things that really would drive the point home, I think, for us in our seat is one, regulatory clarity, no pun intended. I have to say that every time now. But that is by and large, one of hands down the most important pieces here. But secondarily, now that the elephant is addressed in the room, I think for us, it ties back to this original philosophy that I mentioned, where the story is a little bit different today than it was in the past, but history has a sense of repeating itself. And so the thing I'm most conscientious about is this is our time. We have a very tight window to showcase that you can drive real enterprise scale value, and enterprises can anchor their businesses off of building on digital asset rails, and it drives that much upside to businesses, right? And so there's a bit of me like imploring people in the market, but also a bit of internal responsibility where, my goal personally is I want to walk through all of those ICPs that we've talked to from, like I said, from the nation states to all the way to the crypto native neobanks, and say, hey, like this is a use case that has driven impact for each different type of enterprise across the stack. And from a personal perspective, like that's what I'm trying to drive. And that's why I think is absolutely necessary for not only us as an enterprise, but for us as an industry to be able to maintain this momentum moving into the future. We need to show that what we do drives results, and it isn't just something that just drives the sentiment around equity prices.
Totally agree with you. Chunda, we ask all of our guests for their high stakes hot take, which is their boldest prediction for the next sort of 12 months. What do you got for me?
I think by the end of the next 12 months, we will see, I'll name actually two verticals. One is in the access of crypto venue, and then I think one is in the activation of crypto venue. On the access of crypto, I think over 50% of the largest FIs by assets under management, so if you look at total assets under management, 50% of them will offer direct access to crypto on their platforms, I think in the next 12 months. A lot of those firms are making investments into it, and it will be done over the next 12 months. Which is also why I say access is solved, because that's an implementation step, right? On the activation side, I think what the biggest thing I think is a bit understated, but I think is going to be really present is I think over 50% of the neobanks, like traditional neobanks, I'm not talking crypto native or emerge from crypto native rails, 50% of the traditional neobanks will have direct access to DeFi on their platforms in 12 months.
That's an interesting one, because I think that you don't often hear folks talk about DeFi getting like sort of mainstream distribution. And the question is always like where are folks going to access DeFi from? And so you think your big bet is going to be on the neobanks, like global neobanks.
The neobanks will move first, and then there will be other sectors that move as well with them. But I think they're going to be the most prominent sector that people will pay attention to, that will be moving in size over the next 12 months to embed DeFi into their platforms.
Really awesome. Well, let's park it there. Chunda McCain, co-founder of Paxos Labs. Thank you for coming on to High Stakes, Chunda. We look forward to having you on again soon.
That's a wrap on High Stakes, the podcast where Web3 meets the real world. For more insight into how blockchain and AI are reshaping institutions, head to validationcloud.io and follow @validationcloud across all socials. Stay tuned for more conversations from the front lines of innovation. I'm Alex Nwaka. See you next time.